Today, we will talk about common stock, what it is, different types, versus preferred stock. Common stock is primarily a form of ownership in a corporation, representing a claim on part of the company's assets and earnings. If you're a shareholder, this makes you a part owner, but this doesn't mean you own the company's physical assets like chairs or computers. Those are owned by the corporation itself, a distinct legal entity. Instead, as a shareholder, you own a residual claim to the company's profits and assets, which means you are entitled to what's left after all other obligations are met. Traded on exchanges, common stock can be bought and sold by investors or traders, and common stockholders are entitled to dividends when the company's board of directors declares them. Typically, they are paid out of a company's earnings, and the decision to distribute them is made by the board taking into account factors like company performance, future capital requirements, and broader financial goals. Preferred stock is a distinct class of stock that provides different rights compared with common stock. While both types confer ownership in a company, preferred stockholders have a higher claim to the company's assets and dividends than common stockholders. This elevated status is reflected in the name, preferred stock. Common and preferred stock both let investors own a stake in a business, but there are key differences that investors need to understand. Common stock represents ownership in a corporation and entitles shareholders to voting rights and potential dividends. On the other hand, preferred stock gives shareholders a higher claim to the company's assets and dividends, but often does not come with voting rights. In the event of liquidation, preferred stockholders generally have priority over common stockholders in receiving their share of the company's assets. Here are 4 key takeaways. 1. Common stock is a security that represents ownership in a corporation. 2. In a liquidation, common stockholders receive whatever assets remain after creditors, bondholders, and preferred stockholders are paid. 3. There are different kinds of stock traded in the market. Value stocks are lower in price in relation to their fundamentals, and growth stocks are in companies that tend to increase in value due to increasing earnings. 4. Investors should diversify their portfolios by putting money into different securities based on their tolerance for risk. Hope this would help. Thanks for watching.